The sort of the top line number is there's around 5.3 trillion in unsecured credit across consumer and commercial credit products globally. Within the United States, which is our target focus at the start, it's around 1.3 trillion. A lot of consumer credit is unsecured. A lot of commercial credit is unsecured. That typically means is you are super productive, but you might not be asset rich, which is sort of the flip side of what everyone else in crypto is catering to, which is you're very asset rich, but you might not be productive. And so in order to be able to effectively extend credit to emerging businesses, you need to be able to extend credit against their future revenues, future cash flows. Right now in DeFi, it's not quite that. It's sort of you're giving capital to asset-rich individuals, but they are not necessarily productive.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show features the founder of 3chain, a new credit-based money market built on Ethereum. So the big story around 3chain is they are a new protocol that is looking to unlock under-collateralized loans. This has been a long prophesied primitive that we've all wanted as DeFi users. One of the challenges we've all faced is we normally have to put up more collateral than the actual debt that we borrow. But what if we could mirror the capital efficiency in legacy finance by being able to borrow with just a simple credit score?
We talked through the broader implications of how big this could be and just how much it could open up for the rest of the DeFi ecosystem as well.
And per usual, the protocol ties all of the benefits here for us as lenders and borrowers back to a yield-bearing asset. So there will be a stable coin that is USD3, but then there is a yield-bearing version of it, which is called staked USD3. And if you consider the higher rates that we'll be able to charge to borrowers who are not putting up collateral, it could be, a magnet for yield farmers, a magnet for lenders, a magnet for anyone who wants to earn higher stablecoin rates.
We talk about the importance of the evolution of the tech stack that was needed for a protocol like 3chain to exist. And really, it couldn't really have existed until now.
One other point that really stood out for me is around the ability to lend to AI agents. So, we're always talking about DeFi, Ethereum specifically, being able to power this whole new economy on chain for AI agents. Nomadic, what do you recall from that?
Yeah, I think what's interesting about that is Jacob is clearly thinking of that future, and he's building 3chain to be compatible and highly compatible with AI agents. And if you think about it, we talk about this, but they're some of the most probably honest actors when you compare what a programmed agent might do versus what a human might do. So really interesting. He gets into more of the weeds of how that would work. And ultimately, how do you get an agent to repay their loan?
So on that note, just a quick reminder, be sure to subscribe to the Edge podcast by going to the-edge.xyz. That's where you can get real-time notifications for the Edge newsletter, whether it's a new podcast or a new post or yields of the week. And then also check out our link tree at edge_pod. That's where you can subscribe to the Edge podcast on Apple Podcasts, Spotify, or YouTube. And then a huge thank you to our sponsors who make all of this content possible. All of our content is ungated on the Edge newsletter and the Edge podcast. It's made possible by sponsors like TOROS Finance, REDSTONE, Maple Finance, Spark, MANTLE, and more. Otherwise, thanks for tuning in, and we hope you enjoy the episode. Grow wealth exponentially. With TOROS leveraged tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With TOROS, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. TOROS reduces risk and keeps you in the market ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. TOROS Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. REDSTONE is building the Oracle backbone to unlock real-world finance on-chain and next-gen DeFi. With modular gas-efficient feeds across over 110 chains, trusted by 170 clients, supporting over 1,300 assets, from value-accruing stablecoins, liquid staking and restaking tokens, to treasuries, private credit, and commodity tokens, REDSTONE delivers accurate real-time data where it matters most. The biggest platforms and protocols in DeFi today choose REDSTONE oracles, such as Athena, Securitize, BlackRock Biddle, Pendle, Spark, and Maple Finance. If you're building the future of finance on-chain, you need REDSTONE's leading modular blockchain oracle layer. To learn more, go to redstone.finance, and thanks to REDSTONE for supporting us here at the Edge Podcast and Edge Newsletter. Maple Finance is one of my favorite products in DeFi. It is a gateway to sustainable real yield powered by over $1 billion in AUM across USDC and BTC products. And now with SYRUPUSDC by Maple, anyone can earn institutional-grade yield. Learn more at syrup.fi, and thanks to Maple for supporting us here at the Edge Podcast and Edge Newsletter. FALCON Finance, the team behind the fastest-growing synthetic dollar, with institutional yields that are competitive and sustainable, offering yield optimized across your favorite DeFi protocols. Point season is now live. Learn more at falcon.finance. All right, let's introduce Jacob, founder of 3chain. Jacob, welcome to the Edge Podcast. How are you doing?
Good. Thank you. Thank you for having me.
Why don't we start with a little bit more about your background? You worked at Ribbon Finance. It was a notable name in the last bull cycle. I'd love to learn just more about your roots in DeFi.
So I got into, before Ribbon, first sort of intro into crypto was in 2017 in high school. I was writing ICO contracts back then. And that did well, bought a decent amount of ETH, and then sort of left the scene, came back in DeFi summer, got heavily involved with pretty much every yield farming article back then, and that was sort of my first foray into actual DeFi. And so I was a core early member of Hedgic. So then from there, I met the Ribbon Finance guys, Julian, and I was like, hey, I really love what you're doing, structured products for the next big vertical in crypto. And so I joined as the founding engineer around early 2021. So scaled up their structured products, particularly their built out their, back in the day, year-end USDC, put selling vaults, staked ETH denominated covered call vaults. So yeah, scaled that up to hundreds of millions of TVL. And then from there, built out a product internally called Ribbon Lend, which was a unsecured credit facility for institutional market makers. So it's like a Maple Finance, but it was open term variable rate instead of fixed term fixed rate. And that was my first inspiration behind the fact that unsecured credit really hasn't been able to scale nearly to the same extent as other DeFi primitives have for a number of reasons, which we can get into. But I've been thinking about unsecured credit for 3 years.
So Jacob, let's talk through just a bit of the overarching opportunity here. There's been a ton of protocols that I think have attempted in various different ways something what you're trying to do here. We've seen teams try to create on-chain credit scores. We've seen teams try on-chain credit, but like I would say to not a lot of success so far. So maybe can you frame up what some of these early players got wrong? Have you like been a student of the space, kind of like watching some of these past players come in and maybe see what they did right or what they did wrong? Like just kind of frame up why hasn't it worked yet?
Yeah, I mean, there's a whole graveyard of heroic attempts at unsecured credit over the past 5 years. You have guys like Teller, you have guys like ArcX, a few other micro lenders in the space. But basically, there are two reasons why it didn't work. So they failed on one of two dimensions. The first is a lack of robust credit underwriting. And when I say credit underwriting, I mean the ability to effectively calculate the risk of extending credit to someone. And so when you didn't have access to off-chain credit data, you couldn't really do that in a robust way. So that was the first piece. You didn't have access to my actual credit score. And the second piece is, well, even if you get that part right, you still need robust legal recourse. You need to be able to actually go after someone. And so previous attempts failed on either one or two of those dimensions. And what changed in 2024, which was like, okay, I had a 100% conviction, just like everybody else, that this could not work. And now all of a sudden it can, is zkTLS, which you can get into, became commercially grade available. So I'm not an expert in zero knowledge proofs or cryptography, but there are teams that made it extremely accessible for other DeFi protocols to come in and sort of seamlessly integrate that into their workflow to extract off-chain credit data. So that was the primary use case for us. So we could all of a sudden now extract your credit scores, your credit reports, crucially without requiring your social security and date of birth, and without requiring to do a hard check or a hard hit on your credit score, which hurts it. And so given the nature of everybody being privacy conscious, this was a huge unlock for us because now we're getting the same exact data we need to without making significant privacy concessions. And the second piece that happened is we leverage Plaid to sort of extract minimal personal identifiable information from your bank account such that we have a means to go after you if we need to. Also, we don't collect SSNs or date of birth. So all in all, we've sort of thought about this for a very long time, and we've arrived at a solution that actually could work and is not privacy invasive, nearly to the extent that it could have been otherwise.
I want to get to kind of all of those intricate components a bit more, and maybe a little bit later you can kind of walk us through the user flow. But even before we do that, I think it's important just to frame up, I guess, how big of an opportunity this could be if it works out. So can you give us a sense of how big this market could be? And then, I mean, like, obviously, if it all works as intended, and then just the knock-on effects and importance for the rest of DeFi if we're able to kind of crack this.
Yeah. So the sort of the top line number is there's around 5.3 trillion in unsecured credit across consumer and commercial credit products globally. Within the United States, which is our target focus at the start, it's around 1.3 trillion. A lot of consumer credit is unsecured. A lot of commercial credit is unsecured. That typically means is you are super productive, but you might not be asset rich, which is sort of the flip side of what everyone else in crypto is catering to, which is you're very asset rich, but you might not be productive. And so in order to be able to effectively extend credit to emerging businesses, you need to be able to extend credit against their future revenues, future cash flows. And that is, those are the companies that actually scale and drive innovation within TradFi, but also in principle within the crypto economy as well. And so if you can't extend credit to those nascent businesses that are extremely productive but don't have assets to post as collateral, then you're sort of throttling the growth and innovation of a particular economy. So when you think of credit at its core, it's basically a marketplace between capital and productivity. And so right now in DeFi, it's not quite that. It's sort of you're giving capital to asset-rich individuals, but they are not necessarily productive.
Okay, so in case listeners are a little behind on like what is a credit score, I think it's something like we all live with, but just to like define it, and I'm just going off of something I found on Wikipedia. A credit score is a numerical representation of your credit worthiness, essentially a snapshot of how responsibly you manage borrowed money and debt. This 3-digit number, and this is referring to folks in the US at least, so I'm in the US. This 3-digit number, typically ranging from 300 to 850, helps lenders assess the risk involved in lending you money and your likelihood of making timely payments. So over the course of my life, I've made less money, I've made more money, but one of the things I've done since high school was I was good about opening accounts, I was good about paying my bills on time, I was good about taking out small loans over that time and making sure they were manageable. There was something about all of this that I understood early on, and I was able to maintain a higher credit score. And that is what allowed me over the years to potentially open up loans. Like I opened a SoFi loan many years ago related to some house project. I had student loans. When we talk about what's on chain, I mean, my wallets are totally disconnected from who I am in the physical world. And so anyone that would be lending money to me on chain has had to rely on me putting up collateral. What I want to understand is, what does this start to look like with 3chain creating or recreating this credit score on chain, something that doesn't require me to just put up more money than what I'm borrowing, allowing me to, potentially, to your point, borrow against my future income or like my future potential to be able to pay back a loan. Walk us through basically, how does 3chain work?
Yeah. So when you assess the risk of extending someone credit, there are two things you typically look at. The first is you look at your ability to repay. And the second thing you look at is your willingness to repay. And so with over-collateralized loans, you're posting collateral. And so you don't need to look at your willingness to repay because you know they are capable of repaying it. So when you do unsecured credit, part of the significant unlock in capital efficiency is the fact that as a creditor, I'm undertaking the risk that you don't pay me back. And so in order to mitigate that risk, you have to look at your willingness to repay. And so 99% of a user's credit data exists off chain. So how have you interacted with your credit cards, your personal loans, your mortgages? Because those are all reliant on you being willing to repay. And so similarly, given the fact that we're extending you an unsecured credit line, we also have to look at that data. And so that is where the zkTLS piece comes in, which is it's very difficult to just bootstrap an understanding of your willingness to repay just by looking at your on-chain activity. There's you can try and look at, okay, have you repaid hobby loans? But that's not quite the same at all because it's over collateralized. So you might be a responsible borrower if you get liquidated and you don't repay because you're not letting the lender down. And so here we have to look at what you've done before in TradFi to get a sense of what your willingness to repay is going to be on chain. So we're basically not bootstrapping it from the ground up. We're bootstrapping it, taking in like 90% of what you've done off chain. Then we're mixing in some stuff they've done on chain. And we've sort of derived our own credit score called Jane score, which is sort of meant to be this hybrid between both worlds.
So let's kind of walk through some of the other components here at play. You've already teed some of them up. So we've talked about zkTLS. This is that link between the on-chain world and the off-chain world that preserves privacy. I think it's like an incredible implementation of ZK and like a very practical use case. And this was actually one of the first things when I first read one of your blogs. I think it was like something called like the real Ethereum hasn't even been tried yet. I was like, wow, this is like one of the first times I've seen ZK used kind of the way I always thought it would be intended to be used. But you've also got this integration with Plaid, and then you've got this integration with Credit Karma. Maybe just speak a little bit more to how the Plaid stuff works, and then how that rolls into Credit Karma, and just how this all operates within 3chain.
Again, the two things need critically to build a scalable unsecured credit protocol is you need to assess credit risk properly, and you need to be able to go after users, engage in legal recourse in the case that they default or be. And so the first piece, which is assessing risk, that is where Credit Karma and zkTLS comes in. Most Americans have a Credit Karma account, and that is what shows you your credit score and a breakdown of your credit report. And so with zkTLS, we can trustlessly extract that off-chain credit data without having to go through credit bureaus. Because if you want to go through credit bureaus, you need your SSN, your social security number, and you need your date of birth. So we would have needed that data. By going through Credit Karma, we effectively get what we need, which is your credit report and credit data, without requiring your social security number, date of birth. And so that's the first piece. That's the first thing you do when you connect your wallet. You connect your Credit Karma with zkTLS. We extract that credit data. The second piece is you also have to connect your bank account with Plaid. And so with Plaid, what it gets us is we get a bit more indication into the fraud risk side of things, because just to make sure that this is who we really are. And secondly, we can also extract your full name, your email, your phone number, and your city and state. Critically, we also work with collections agencies who have access to commercial databases that can then go and triangulate who you actually are. So it gives us like the minimal viable information about who you are to actually be able to go after you. So it's like the furthest out we can possibly go without compromising our ability to collect on debt.
This episode is brought to you by MANTLE, pioneering a revolutionary new category called blockchain for banking by bridging TradFi and Web3 into one unified stack. With on-chain transactions, TradFi rail compatibility, and integrated DeFi features, MANTLE is reshaping how financial services work. Their flagship app UR lets users hold fiat and crypto all in one Swiss-backed account, making real-world finance usable on-chain. To learn more, go to ur.app and follow mantle_official on Twitter. Spark, one of the leading DeFi protocols, has had a year like no other, deploying $2 billion into RWAs with BlackRock's Biddle and other institutional giants, adding over $1 billion in TVL, and distributing over $9 billion across the DeFi ecosystem. Now, Spark are setting their sights on further global expansion and have introduced the Spark token, which is available on leading centralized exchanges. There's never been a better time to discover Spark, the on-chain capital allocator. Learn more at spark.fi. Actually, on that note about collecting on debt, what does that mean? You know, when you don't pay a bill I'll say at least in the United States, if you don't pay a bill at some point, you'll have folks calling you. You could ultimately be passed over to a collections agency. And at some point, if you're unwilling to pay that bill, I don't know the exact term, maybe you do, Jacob, but like there's like a charge off or something. Basically, something very negative goes on your credit report. And if you ever look at a credit simulator, it'll show you that by not paying a bill, I mean, it really goes against your credit score. I've played with simulators and I'm pretty sure it tanks. Like if you had an 800 credit score, which is very good, you will, go down like maybe 200 points or so. So now you're at a 600. So you go from being someone who's getting the absolute best borrowing rates, the best loan offers, to being in a place where you might even get questioned trying to open up a new credit card, any sort of like new loan. I've always wondered, like, how is this going to translate over to folks borrowing on chain? I'm assuming, again, that there's some sort of similar process here to, collecting on debt if someone's unwilling to pay it.
So we did a lot of iterations with our legal team. This was a huge legal feat, as well as an economic feat, as well as like a technical feat. There's a bunch of different disciplines, but on the legal side, it's a very long process. We arrived at a structure where these are commercial advances. and they are minimums of around $5,000 to get a credit line from us. So we're not going after like non-crypto natives who need to pay off their bill. We're going after guys who largely want to use these credit lines for commercial means. They want to use it for more yield farming or trading or some working capital needs. And we've arrived at the conclusion that the most effective way to collect is not to ding your credit score. It's to just go after you in the legal system if we need to. And that's typically how it works for commercial credit. For larger sizes, it's like hitting your credit score is not going to be really meaningful at those sizes, like $100,000 credit line. You kind of just want to go after them legally and try and recover it. So that's largely how it's going to work. We're not going to be resorting to hitting your credit score. We're going to be going after you, going after your assets and going through the legal system if we need to.
Jacob, so I know these loans aren't live and available yet, but I believe the credit score algorithm is being created and enhanced sort of as we speak. Correct me if I'm wrong, but can you explain this process that's kind of ongoing right now with how 3chain is basically getting smarter, bringing in data, and just creating this, I guess, proprietary credit score algorithm?
Yeah, we have you think of it as a slow flywheel of collecting more and more data. So we're starting off with $10 million credit lines to, less than 100 users. We collect their credit data and we see how they perform for repayments. And then we use that data to refine our algorithm and to adjust our probability of defaults. And then we take in more capital. At this point, we're smarter than we were before because now we can more granularly assess the credit risk. So on a high level, it's called 3CA, the 3chain credit risk algorithm. The credit score is only a small piece of that. Like it's a big system where we're basically looking at the fraud risk. First of all, like making sure this is really you. Like that's a problem if it's not you. And then once that clears, then we start looking at the credit risk side of things. So then we look at what is your credit score? What is your on-chain credit score? We work with guys like Blockchain Bureau and Credit Protocol. And then from there, we get a better sense of what the risk premium should be on top of Aave's sort of the risk-free rate in crypto being Aave, what sort of the premium that we need to add on top of that to properly compensate for the additional risk. So that's the risk premium. And then we go out and look at your actual assets. And then like we have visibility into thousands of protocols on chain at this point because we can underwrite at a much faster velocity because it's unsecured. So we look at all of the assets that you hold and we assess what sort of credit line sizes that we want to give to you. And so at the end of that, it goes through the fraud risk engine, the credit risk engine, asset risk engine, and then the portfolio risk engine. At the end, we spit out the risk premium and the credit line size that we want to give you. And so, yeah, that entire process, it's still nascent. But as we collect more data on delinquencies or defaults, say, as we collect more data on repayments, we would be able to update what our credit risk premium should be.
Jacob, all that you mentioned going into this 3chain score, is this automated? Are you using AI? Like, what can you tell us about it?
So the fraud risk is still manual because these could go up to $1 million credit lines. Like these are large credit lines. And so at the start, that has to be done manually. So the fraud risk side is manual, but everything past that is pretty automated. So that's like in real time, looking at your credit score, real time, looking at your assets and then deriving credit lines. So at the start, it's going to be like a manual turnaround time. But as we scale up, it's going to be connect your Credit Karma, you connect to your Plaid. In real time, we post on-chain credit lines, risk premiums. you can draw down on it in real time. So end to end, it should take less than 5 minutes. It should look and feel just like any other DeFi protocol.
And something we haven't talked about yet in this arrangement is, I guess what's underpinning a lot of this too is this yield coin called USD3. And then there's also SUSD3. Can you talk to us about how these contribute into the protocol and just generally how they function and work?
Yeah, so we're a two-sided marketplace, just like Aave. On one side, you have creditors coming in. The other side, you have users coming in and drawing down on their credit lines. So on the supply side, USD3 is, you can think of it as like a senior tranche, like in an asset-backed security. Like in TradFi, basically, banks would compile a bunch of mortgages, like millions of mortgages together, and then they would securitize it, and then they would divvy up the risk of that, and then sell it off to investors. And so you might have like the AAA, which is like the most senior and the most safe, all the way down to like, double B minus, which is the riskiest. And they have varying levels of risk, but also varying levels of yield to compensate them for that. And so you can think of USD3 as a senior tranche. It gets less yield, but it also has a buffer from SUSD3 in terms of losses. And SUSD3 gives you levered exposure to the pool. So it's riskier, it's higher yield. It's like, I think based on our calculations, it's going to be in excess of 20% on organic. So not including incentives. But it's also subject to first loss capital. That's the risk profile. In terms of what you can actually do, the idea is you can take USD3 and SUSD3 and interoperate on it and compose on it across other DeFi protocols. So you can imagine you can get more leverage against it on money markets. You can do yield swaps or interest rate swaps on that through Pendle, which is all very popular. We imagine also that there are actually going to be new DeFi protocols that are going to be enabled due to having this foundational unsecured DeFi primitive on top. So I actually think the rabbit hole goes much deeper in terms of the new primitives that can be built and used on top of USD3 and SUSD3.
Jacob, how do repayments work for borrowers in this setup versus maybe something they're more familiar to in an over-collateralized setup?
I mean, I can briefly speak to that. It's basically like in Aave or Morpho, you don't need to make any repayments. You get liquidated or you don't, and the creditors or protocol is okay with you not making any repayments because they know they can always liquidate the collateral and make themselves whole. But for us, we don't have that at our disposal, and so we need to rely on repayments to make sure that you are sort of there. You're there, and it's like kind of like it serves kind of like a liveness check, and it also serves as a way to mitigate the risk in case your assets goes down or something happens, and we just want to make sure that it slowly amortizes and we get our repayments. And so the repayments are structured on a monthly basis, and they are based on the yield that you've generated within DeFi. So we take a portion of that, and we ask you to repay it. It might be zero. It might be close to zero. At times, it might be a higher percentage of your principal, depending on what goes on in your portfolio.
This is probably like the maker style where the staked portion takes everything. Is this kind of the arrangement or like the Athena model, essentially?
You can think of Athena as USDE is basically the senior tranche, and USDE senior tranche, SUSDE is junior tranche, except all the yield from the senior tranche is directed to SUSDE. So basically, USDE is an unsecured loan, but it's a stable coin, which I'm a big fan of Athena, but that's what it is. And you're incentivized to keep that because you get yield in the form of ENA rewards. The difference with us is it's also sort of the senior junior, but we still USD3 still gets yield. like USD denominated yields, as well as SUSD3. So they both get yields. USD3 is not a stable coin. It is yield coin, like it generates yields. On top of that, you would get Jade rewards for both of them, but that's separate. So that's sort of like the mental model for it.
Hey folks, I want to tell you about our sponsor GEARBOX, the protocol that reimagines on-chain lending. With GEARBOX, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about GEARBOX, go to gearbox.fi. Rumple Labs is revolutionizing DeFi. Rumple lets you turn points into profits by tokenizing rewards you can trade from top protocols like Pendle, Athena, Fluid, Symbiotic, and many others. No more waiting for airdrops or TGEs. DeFi's smartest investors are already using Rumple to unlock instant liquidity and maximize their yields. So join Rumple today and start spinning your points into gold. Learn more at rumple.xyz. Puffer Institutional delivers secure, high-yield Ethereum staking built for institutions with battle-tested security, granular access controls, and the ability to boost APY by securing multiple AVSs. Puffer gives institutions full control and optimized returns. Puffer is also behind the Unify-based rollup, aiming to transform Ethereum's future in a world where all L2s are working together. To learn more, go to institutional.puffer.fi.
You started to talk about like more novel use cases where I guess protocols could come build on top of 3chain. I guess maybe speak a little bit more to that. What does this open up for DeFi in general with what you're building? Like, is there any kind of new primitives that you think will emerge that, you know, people haven't even thought of because this didn't exist yet?
Yeah, I mean, one that comes to mind, which is sort of the easiest slam dunk, is like, okay, you can now have credit defaults. And a neat primitive for that is symbiotic and eigenlayer, because you can actually repurpose that stack for sort of like a general purpose insurance. And so you can imagine that I restake my ETH into symbiotic or eigenlayer, and I can basically sell credit default swaps against other primitives. And so you can imagine that I'm going to be selling a credit default swap for Cap Labs. They have surety bonds, but similar idea. And at the same time, you could be selling credit default swaps for 3chain. And so a staked ETH holder could be earning yield from both credit default swaps on Cap Labs and from 3chain at the same time. The reason you can do that is because the risk of both of them defaulting is not necessarily a correlation of one. Like none might be fully correlated. And so the analog to that in TradFi is insurance companies. They might have $10 million, but they are extending insurance for 100x that. And the reason they can do that is because the likelihood of my house setting on fire in Colorado is not associated with the likelihood of my house in Maine setting on fire. And so I can basically use the same dollar for both of them. And so you can imagine just significantly juicing up your yields for state holders, and that's all it needs. So that's the first example of credit default swaps. The second thing is, I think there's a lot of interesting stuff that Iron Bank, which is a very old protocol. I don't know if I'm sure you guys remember it, but basically they were lending to Cream and others. And so it's sort of like between different protocols, they're extending unsecured lines of credit. And so you can now start extending credit to other DeFi protocols. And it was difficult to do over collateralized because it's like, okay, they don't have tokens, or they might have future tokens, or they have revenues, or they have yield in other forms. And so now you can sort of extend credit and build out those DeFi protocols as well. And so the only way you can really do that is unsecured. So there are a lot of interesting ideas around extending credit to other DeFi protocols. like, for example, like I'm really thinking about Pinto, which is like they're trying to reinvent how algo stables work. I don't know. Like, I'm not an expert in algo stables, but they're doing a really interesting design. And so, we're looking at that. We're looking at other DeFi protocols like Wildcat. Like, there are a lot of ways where we can sort of extend credit to other DeFi protocols and maximize yield in new DeFi primitives.
Okay, so if you go to app.3chain.xyz, there's a banner up top. It says connect now for Q3 early credit access. So I don't know if you're able to share all of what we can look forward to here, but I mean, first off, as a lender, like that's going to be the easiest way for someone to get involved. What can we expect there? I mean, are we just depositing USDC or Tether, or like what's acceptable for deposits? And yeah, what else goes on there?
Yeah, so on the supplier side, it's only USDC. So you only can deposit USDC. You get back USD3. You can then go ahead and stake that USD3 for SYRUPUSDC, which again gives you levered exposure to the pool. That is currently permission for we have certain private LPs that we're talking with to seed the initial capital and make sure that everything's running smoothly and that end to end it's like as we expect it to before we open the door to everybody depositing. But deposits will be permissionless in Q3. On the credit line side, we have our initial cohort of 100 users who are going to be drawing down these credit lines, but that will also become permissionless for anybody in the United States to get that access to their own credit line. That's also going to be in Q3.
So for this Q3 rollout, as a borrower, let's assume I've connected a MetaMask wallet, I've connected a Credit Karma score, a Coinbase score. How long, like what's the lag time before I can, start actually borrowing?
It should be 24 hours. So the 24 hours is only so we can properly do the fraud risk side. So you connect your wallet, 5 seconds. Connect your Credit Karma, 1 minute. Connect your bank account, 1 minute. That we review, and then in 24 hours, we post your credit line and risk premium on chain, and you can start drawing down. So end to end, it should be within 24 hours.
There's a whole angle here where 3chain is building for not just humans, but also agents, I believe, as well. Can you maybe speak to, how you're positioned for this agentic future? Maybe how much you're even thinking through this side of the equation. Like, do you see this being a big component in the future? And maybe like, if so, how soon?
Yeah, I mean, I think from first principles, if we think about what makes money, like money is made from productivity. Like you make a business, you get an investment and you turn $1 into $3 by providing some good or service. And for the past several, thousands of years, the productivity is done by humans. But I think over the next decade or so, we're going to find that more and more of the productivity, which actually generates money, can be automated or done or reasoned by agents. And so you can imagine that you're going to have these cybernetic businesses. At the start, like imagine a business is like 100%. And over time, we're going to see a shift where, okay, maybe like revenue operations is automated by agents. Coding is done by agents. And so before you know it, it's going to be like, okay, well, who's actually running this thing? And I think over the next decade, we're going to find that increasingly the answer to that question is going to be agents, with the exception of maybe like super high level reasoning that a CEO might do. Like one person unicorns are like definitely going to be a thing in the next 10 years. And so the idea is that you want to be properly positioned for that terminal state of credit markets, which is the future is all the productivity and revenue generation is going to be done by agents. And you need to be able to interoperate with them and be compatible with them and talk to them such that you can properly assess the risk and properly extend them credit. And I think the future of that is going to be on crypto rails. where you have capital formation from across the world deployed into 3chain, and 3chain is going to be able to, in real time, underwrite agentic businesses, first in the United States, maybe then abroad. One interesting thing here is that from there, it's like collections aren't really a thing. Like if it's like programmatic, then it's like, okay, then you're really only assessing the health of the business, and you're less about assessing the risk of, what's the turnaround time of this guy not wanting to repay, because it's like programmatic. Like the first rule of like an agent is not to kill a human, and the second one might be like repay your debts. So that's going to like change things significantly, and we want to be positioned for that future, and it's certainly not going to happen within the next year or two. I think we're going to see early signs of that within the next 5 to 10 years, where there's a decent amount of businesses that are structured in that way that you would be able to underwrite, and banks are going to be sort of left in the dust.
You totally answered my next question, which I was like sitting here listening, and I'm like, how the heck do you get this agent to pay back a loan eventually? And I'm just picturing them becoming more and more aware, and then one day the big heist happens, they just run off into the ether and never pay it back. But probably not. Probably watching too many movies, but maybe not.
No, I mean, I think that's reasonable. I think that's reasonable. I think there are certain safeguards you could put in place. But yeah, this is all like super high level cyberpunk stuff, and it's not concrete in any way. But I think for first principles and intuitively, like it kind of makes sense that this is where it's going to go.
So Jacob, anything you can tell us about a potential 3chain token, how it would work, any utility that it would have within the protocol?
So there will be a Jane token. It will be used to incentivize both the supply side and on the credit line side. We are don't want to commit to anything on the utility side, but we're exploring a lot of interesting dynamics. One interesting dynamic is if you default, we can claw back your Jane rewards and redistribute it to other good users. So that just adds another notch in the set of incentives to prevent defaults. So there's an interesting game theory to that. But yeah, there will be a Jade token. It will be used to incentivize both sides of the marketplace. There will be clawbacks for users who default. We are really trying to set up this liquidity mining program and subsequent tokenomics to be true to the roots of DeFi. So probably not going to do points. I can commit to that.
With the rollout of USD3, can we expect a Pendle campaign or a Pendle pool?
There might be. We're exploring that direction, but there's nothing set in stone yet.
Makes sense. Well, guys, I think this is probably a good place then for us to start to wrap up. So first, I want to remind our listeners they should learn more about 3chain by going to 3chain.xyz. They can follow 3chainxyz on X or Twitter, and then they can follow Jacob's personal handle. It's _YAKOVSKY. We'll put that in the show notes so you can easily find it. Jacob, thank you so much for coming on. Just so interesting to learn about like what you guys are bringing to market. We're really excited as users to get to try this with the Q3 rollout. I was having to restrain myself from connecting more wallets on 3chain as we were talking. I had played with the app and already spit out like a number, but then I started realizing it's actually improved since whatever was the initial like beta rollout. I've noticed there's more ways for you guys to score us with the 3chain score. So just, really excited to, find more ways to be able to borrow without having to put up a ton of collateral. But any final word for us before we go?
We're really excited to roll this out. I do feel like this is a shared vision, based off of the early conversations we've had. We've like an overwhelming amount have said we've been waiting for this forever, and I do think it's gonna significantly disrupt the how credit works within DeFi. So it's gonna make it look like an actual economy.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, Subscribe to our free newsletter at the-edge.xyz.